So interest rates have been on the rise and the fall, but we've seen relatively nothing going on with dividend rates on whole life policies. So what's going on? Is the industry trying to move away from this once revered product? Let's get into it. I don't think I'm the first person who's calling attention to the fact that interest rates have been bouncing around as of late. In fact, back in January of 2022, the Fed funds rate went from practically zero to over 4% by the end of the year and kept marching up through 2023 to a peak of 5.33%. Now, the Fed has recently announced its intentions to reduce the Fed's funds rate by 50 basis points, and happening at the same time, the bond market has had yields moving quite a bit higher, but also bouncing around considerably more than the Fed funds rate. In fact, if we use the Moody's Corporate Bond Index for AAA rated debt over the same time frame, January of 2022, it started at something like 2.93%, ending the year at 4.43%, and peaking out in October at 5.1%. Obviously, corporate debt is significantly more volatile than the Fed funds rate tends to be, but this is a testament to the movement of interest rates, which has been quite substantial over the past couple of years, despite the fact that when we look at whole life insurance dividend rates, they've been pretty static. We've seen some very modest moves upward among a couple of different life insurance companies. But for the most part, the movement has been quite unremarkable, quite unexciting, despite all of the things going on in the interest rate markets that exist inside the US economy. So why? Why are we not seeing the same movement in dividends payable on whole life insurance as we are seeing interest rates move around for things like your savings account, things like bond funds? You can go out and get interest rates. You get CDs now that are paying remarkably better than they were just a couple of years ago. Why not also the movement in whole life dividends? The answer to this has a lot to do with the way the life insurance industry approaches the process of money flowing in and money flowing out. Life insurers match assets with their liabilities. When an insurance company issues an insurance contract, it's making a certain set of obligations to policyholders. And in order to make good on those obligations, the insurance company needs to provide itself with a certain degree of income. It goes out and it buys assets that can provide it with the income necessary to produce that guarantee it has created to its policyholders. And it does this primarily by buying bonds. The results that come from matching assets to liabilities put insurers in a position where income that was purchased years ago is still income that will prevail to maturity. There's no doubt about that. Insurers are really good at picking bonds that have relatively high credit quality. But it also means that insurers are slow to react to changes in the interest rate market. Let's use an example that has absolutely nothing to do with life insurance to explain how this might function, to give you a better understanding of why it is insurance companies are slow to move dividend rates, even in a rapidly evolving or rapidly moving interest rate environment. Let's say that you are in the market to buy a new car. You go, you pick one out, and it turns out that the loan that you're going to acquire to buy the car is going to cost you $800 per month for the next 6 years. If you want to lead your life like a life insurance company, you will go out and buy assets that will give you the income that's necessary to service the debt for the next 6 years. If the current bond market that you are buying in is paying yields of 5.5%, you're going to have to buy up about $175,000 worth of bonds to provide yourself with the income that's necessary to cover the loan payment on your car. Now, if a year after you buy those bonds, interest rates rise to 6%, that doesn't mean a whole lot to you. Now, in truth, the bonds themselves aren't worth what they were when you bought them. If you were to sell them on the open market, you'd have to sell them for less than $175,000. Nobody wants your old bonds paying 5.5% when they can buy new bonds paying 6%. The good news is you don't have to sell your bonds, and you're not going to sell your bonds. You're going to continue to collect the income that they provide, and you're going to continue to pay your auto loan as it comes due. But let's say another year has gone by. The yield on bonds has risen yet again to 6.5%, and now your wife needs a car. It also happens to be the case that she's picked out a car that will come with a auto loan payment of another $800 per month. The good news is you can buy bonds at higher yields. Let's say you still have $175,000 though. This means you're going to be able to buy up bonds that have a yield that is in excess of the monthly income you need to cover the loan on your wife's car. You're going to have actually about an extra $150 every single month. This means that you've got additional money that you can use for some other purpose. You can put it somewhere else and do something else with it. Something like this is currently unfolding inside the life insurance industry as it relates to yields on bonds. Insurers have known for a number of years that the interest rate environment that we were existing in back in the 20-teens was unlikely to last forever. But they also knew that they had to take the premiums that they received and buy assets that were going to provide them with the income they needed to cover the liabilities that they obligated themselves to when it comes to issuing policies to individuals. But as interest rates have been on the rise, insurers still own a lot of old bonds that are paying income of some level. Some of it's really good income. Some of it's income that they would have preferred to be higher at one time, but that's just the way things worked at the time that they were ready to buy bonds. But as they collect new premium and as old bonds mature, they're able to roll into now higher yielding bonds, which means they're able to buy up income that is more in excess of what they needed in terms of obligations from the past. The good news is this starts to create the money that's necessary to pay higher dividends, but it doesn't happen instantly. It's for this very same reason that life insurers have been stylistically known to be slow to react when interest rates went down. In 2008, following the massive financial crisis that took place there, we saw the Fed begin the process of quantitative easing, and interest rates started to fall economy-wide. Despite that, the dividend rates payable on whole life policies remained, in most cases, quite high, especially by market interest rate standards, and they stayed that way for a number of years. This same principle will come into play now that interest rates have been on the rise. Life insurers will be slow to react because they have to cycle through the income and the bonds that they already own. They're not going to sell them. The ultimate hold to maturity investors. But they've also been aware of this reality for some time, and they've made investment decisions that hedge some of their bets on this. For quite a number of years, we've watched life insurers buy a lot of bonds on the low end of the duration scale. And now we're starting to see them buy somewhat more on the higher end of the duration scale. Let's not also forget that just a couple of years, the life insurance industry won a massive legislative victory when it was allowed to issue new contracts under quite significantly lower guaranteed contract provisions, freeing up a lot of capital to pursue certain investments that likely produce higher income, which will absolutely feed into the dividend. And we have begun to see announcements for dividend increases. They've been very modest to date, but they are happening and they'll probably grow. In fact, we just got word last week from one insurance company that's raising its dividend, and I think is so excited about it. That explains why they made the announcement about a month and a half earlier than they normally do. This movement in dividends is going to be something I think current whole life policyholders are going to find quite pleasing in terms of cash value accumulation. And for those who are looking at whole life insurance as an option to diversify risk and save and accumulate wealth and some other alternative means, are going to start discovering that this product has a lot of strength behind it, especially in an environment where interest rates are on the rise. But just as it took a good 5 to 7 years before we saw the reduction in dividends following the 2008 crisis really hit their rock bottom, we're probably in a similar cycle when it comes to seeing dividends reach their peak. And even though the Fed is headed in one direction, that doesn't necessarily mean the corporate bond market will follow in lockstep. In fact, since the Fed announced its 50 basis point rate reduction plans, the bond market has produced yields that were up more days than they've been down. This, of course, provides ample opportunity for insurers to continue to buy bonds at substantially higher yields than they were able to purchase them just a couple of years ago. On top of all of that, a lot of these companies that are generally mutual and very heavily engaged in the issuance of dividend-paying whole life insurance, have been sitting on considerable stockpiles of cash for some time. They have the means to buy up a bunch of bonds when the opportunity presents itself, or at least looks like it's the best opportunity to purchase bonds to lock in certain income in excess of their liabilities. Not only that, but despite record-setting low interest rates that prevailed throughout roughly the past decade, every life insurer that is engaged in the issuance of dividend-paying whole life insurance has maintained a ratio of investment income to contract liabilities that's positive and actually very positive. Most of them are able to produce considerably more income from their invested assets than they are committed to in terms of contractual obligations. And that gap is where a huge percentage of money comes from to pay dividends to policyholders. But it's only one of the pieces of the pie, and there are two others that are pretty substantial as well. Mortality, which continues to improve in a lot of cases, which will help ultimately the profitability of insurance companies engaged in dividend-paying whole life insurance. And administrative expenses, which for years we always thought would always be a drag, but the efficiencies that have come along lately in terms of technology and work from home situations have led to a substantial cost savings when it comes to operational expenses insurance companies are facing. While it's still very likely to be the case that investment income is the key driver of dividend movement, these other contributing pieces, mortality and operational expense, could end up additionally buoying an already favorable condition, which is rising income from invested assets. So despite the low propensity to move dividend rates in the face of a rising interest rate environment, I think the best advice is to practice a little patience, and you will be handsomely rewarded for it. Whole life insurance isn't dead. In fact, we have seen new products roll out very recently that look extremely promising when it comes to whole life as a cash building option, diversification play for wealth building and portfolio hedging. And we suspect there are other insurance companies very much plotting out their goal, their strategy to build and bring to market similar products. So despite all that's gone on in the economy, all of the innovation that's happened elsewhere in the insurance industry, I think whole life insurance is very much alive and well and will undoubtedly continue to hold its own in a somewhat crowded marketplace of options when it comes to safe wealth accumulation.